Stock markets around the world look like roller coasters. Property's taking huge dives all over the place. Inflation is running rampant, and interest rates just keep going up. It's pretty safe to say we're deep into the recession right now. I don't really care what, outsiders say. They try and calm people down by saying, oh no, we'll be able to ride it out. It'll be a soft bottom. All these different phrases to try and keep you believing that it isn't what it is, which is a full-on recession. Whether we're going to get a massive crash or not, that's yet to be seen. But I'm going to tell you right now, my people have flown in from all over the world this weekend to have a discussion just on how big this recession, crash, whatever terms you want to use, how big is it going to be? We think it's going to be quite large. So what does that mean when a recession turns into a crash? Well, we all went through what happened at the beginning of the pandemic. Things were not very happy. Nobody was getting along very well. But that was, in comparison to a crash, a very minor ripple when you compare it to a worldwide crash. 08, 09, some of you may remember that. A much, much bigger, much more negative for most people situation. That still wasn't really a crash. It was just called a crash because we hadn't seen anything that big in our last few lifetimes. What came out of that? We know that people that weren't prepared and had too much bad credit, took out money to buy things that they didn't need. We know that those people are hurt really bad. But what came out of it? Those people who always kept themselves a little bit liquid, made the right moves, invested at the right times, they came out of that crash in 08, 09 extremely wealthy. And that's what this show is going to be about. This episode is directed towards those who want to know how to turn what they have now into wealth in just a few years. This episode is going to cover mainly property in and around the US. I'm going to give you our top 5 picks of places that are going to take the biggest hits, cities that are going to see the biggest drop in values of their property, which subsequently allows for the biggest investment potential to come back in 2 to 3 to 5 years. This is the kind of information that if you were to go sit down at, let's say, a seminar or a real estate guru's, dream discussion, you'd pay $50,000, $100,000 to get in on this type of knowledge because it would make you millions. That's right. We're not talking a little bit of money. We're not talking 5 or 6 figure type dollars. We're talking 7, 8, and 9 figures worth of money that you could generate over the next 4 to 8 years if you make the right plays in the next 2 years. And we're going to start with something that everybody knows. We're not going to get into anything else other than property. The top 5 locations that we see as the biggest investment potential, and I'm even going to throw in one of my own at the very end. So let's get into them. Number 1, we're not ranking these in any order of importance, just number 1, Jacksonville. This was an area that was way over speculated on. Huge vacation area, huge vacation home area, a lot of Airbnb. Speculators way over invested. They bought up too much of the property. Don't get me wrong, they did make money over the last decade, but they bought up too much property, developed too much property, and it was in a way too great of a proportion based off of the amount of people that actually lived there. There are way too many units available on the residential market. Now you insert this recession or this crash, and what you have is you have less vacationers, less people renting Airbnbs, less people leaving their state to go vacation in their secondary home, and that equals less revenue coming in. And you couple that with the increasing costs of holding the properties, i.e. the interest rates that have gone up, and these houses have to be sold off. This could be one of the highest price decreases that you'll see across the US. Jacksonville is going to see some major decreases over the next 13 to 18 months. Now, do you want to get in right now? I'm not sure. Again, none of this is advice. This is just knowledge for your own database in your brain in case you do want to make moves later on. I suggest you always do the research. But we believe Jacksonville is going to take a massive hit. Second city on our list, Tampa. The average household income in Tampa is less than $70,000 a year. This is only roughly 15% more than it was back in the '07 peak before the crash. During the '08-'09 crash in Tampa, you saw prices go down almost 40%. Huge, eh? People that had bought in '06, '07 basically lost 35 to 40% of their value within a few months. The current average home price in Tampa as of today is 30% more than it was back at the peak in '07, just before the crash. Now, if you're doing any of that math, you can obviously see wages haven't gone up. The values are even higher than they were in ratio to people's incomes than they were back in '07. It crashed 40% in '08-'09, and being over 30% higher than where it was in '07, you can imagine what that means over the next 12 to 16 months in Tampa. That's right. You could see that 40% drop again, and if it stays in relation, maybe as much as 50. Hate to speculate, we're not promising that it will, but that's where we see, and that's what we're watching for. Tampa's not necessarily somewhere that we would be interested in investing in, but it is obviously an area that you should keep your eye on if that was an area of the United States that you were looking at purchasing. The next one is on a lot of people's radar, and that's Nashville. Last year at this time, there were less than 2,000 units available for sale in Nashville. Compare that with the same time this year, and there's already almost 7,000 units available. The average price on these $7,000 homes is increasingly coming down to initiate more sales and try and unloading the property. We're already seeing that. The listed price is coming down weekly to try and move this property so they don't take as much loss as they would if it takes longer holding out for the higher price. We feel that a further 20% drop is more than reasonable. The next city on our list of 5, you've probably all heard of. It's been in the news. It's a city that was heavily invested in for the tech segment, and that was San Francisco. San Francisco is already 20% down from this time last year. So it saw one of the very first slides of what this recession was bringing on. When you combine the skyrocketing prices over the last 5 to 8 years with the tech industry booming and everybody moving to that area and all the CEOs, these big companies bringing up the values, purchasing for rentals and all that, you got these skyrocketed price. And when you combine that with the tens of thousands of layoffs that have happened in the tech sector, you can imagine what happens with a market that's already overinflated and tens of thousands of people that no longer have a job. With unemployment that low, you're getting so many families moving out of the area and even out of state to go to places which much lower taxes and much lower cost of property, whether it's rent or purchasing. This is one that's very hard to speculate on because if tech doesn't make a huge rebound, there's no bottom for the market to fall to as far as property. It'll never be an undesirable location, but it won't be a hyper desired location. So there is, like I said, there's no ground floor for how far the property values can fall in the San Francisco area. If it's an area you're interested in, I know that we'll be there taking a look at things in about a month and a half. Definitely tread lightly. There is no guarantee that it'll ever recover to the areas where it was, to the heights that it was like 3-4 years ago. But that being said, it's maybe not a bad time to start watching their markets if you've always wanted to live there and you're willing to pay a little bit more than, let's say, it's worth, but you're going to get it at the best price over the next couple of years, 12 to 14 more months. Number 5 on our list is a place that we actually quite enjoy. We hold property there, and we have picked up every time, the markets come down. 08, 09 we picked up, 14 we picked up a little bit more, and it's done very well for us. Again, not advice. This is just a place that our group likes to invest in, and that is Phoenix. Phoenix is already down double digits in housing values just over the last few months. This has caused sellers to gradually lower their prices to attract buyers. This means the sellers are motivated to sell. This is a good sign for buyers. Again, if you want to look at why it's coming down so quickly in Phoenix, and actually a lot of areas in Arizona, it's because investors, baby boomers, people looking for retirement homes, Airbnbs, investment properties, second properties, bought up so much over the last decade. And when you're buying, it means you're developing, it means a bunch of money's being pumped in, you see the hype, it draws in more interest, more people buy, and it keeps going up and up and up and up. So the more something swings up based on hype, the more it's going to come down when there isn't the free money to invest in secondary properties or investment properties and such. So it's an area that we're definitely keeping our eye on. It was overdeveloped. There's too many units, brand new units sitting vacant, and it's definitely an area that we're interested in not only picking up properties for long-term rentals, investments and such, but it's an area that we might want to purchase to complete projects as well. There's a ton of money to be made if you buy up incomplete projects, as long as you know what you're doing, completing them, holding on to them, renting them out, waiting for the value to come back up, making the money while the markets come back up, and then being able to sell them off just before the next peak. That's how that type of game is played, and that's a multi-million-dollar game. It's super fun to get involved in, and I really hope a lot of people look at real estate the proper way, because most people don't know how to invest in real estate. If you have any questions, please put it down in the comments. We will respond to every question. All right? Now, we're going to get into the one city that is basically America's city when it comes to the American dream, luxury, partying, nightlife, shows, everything it could possibly be. And that city is Las Vegas. Anyone who understands real estate in North America understands that Vegas is the place to watch for potential investments. It tells you everything you need to know about the American market. When things start coming down, interest rates start going up, recessions start hitting, people look to unload their Vegas secondary homes, investment properties. That's the first place they start unloading them. So if you always keep an eye on the Vegas market, you know what's actually happening. You don't have to worry about an economist to tell you, or the government to tell you, or the reserve to tell you whether there's a recession coming. Just watch the MLS listings in Vegas, the residential markets. The moment things start selling off at 10 to 15% more than usual, you know that something's happening across the US. And Vegas has been coming down for the better part of the last 14 to 16 months. It still has a lot more to lose. But on the upswing, when you start seeing purchases being made, and again, just follow the listings. It's okay if you're 3, 4, 5 weeks late, but just follow the listings monthly and watch what a value in this area goes for. And this is the difference between people who buy blindly and people who buy as investments. People who go at it as investments will keep watching monthly. They got some of them even weekly, and they'll pick the area that they want to buy. And they'll watch it and they'll say, ooh, maybe a condo in this area or a house in this area is this price this week. Oh, it's this price next month. For the next 3 months, it's kind of staying stagnant or going down a little bit. And then all of a sudden it'll drop to a point where you're like, well, you know what? That's actually worth purchasing. It doesn't matter if it goes down a little bit because you're getting a 25-year mortgage anyway. So it doesn't matter if it drops another 10 or 15%. You're going to get in where you're comfortable to get in. That means you've acquired the property. You're making the payments. You make sure that the numbers all make sense for you against the current mortgage rates, and you own that property. At the same time, Because you own it, you're going to watch where the market is on it. Maybe it drops a little bit more and there's another unit right next to it. You pick up that one as well as things are coming down. You're never going to know when the concrete bottom is. But the beauty is, if you're averaging down on your costs, if you're really good at working the numbers, you get people in to rent it at rates that at least cover your payments. That's it. Don't look at trying to make a ton of money off renting it out. That's not the way you do it in a recession. Because what happens over the next 18, 20, 22, 24 months as we've hit that hard bottom, because it's not going to be a soft bottom, those with money will start purchasing again. Believe me, the wealthy did not become wealthy by stealing from the average person. The average person doesn't have enough to steal from. The wealthy people just make their plays when everybody else has to sell. So what they're going to do is they're going to have the liquidity or the ability to leverage other assets to start picking up at the bottom. And the more investors become sure of their investments, the more they buy. Then it starts creeping up. And then all of the USA and all the real estate agents and all the investors from the outside who are watching Vegas, because they know to watch Vegas, like I just said, they're like, oh, it's coming back. Because the nice thing about Vegas is people will fly in from around the world to go to Vegas. They'll come from other states to go to Vegas. So it doesn't matter if Nevada itself is making money. Anywhere else in the United States or Canada or Mexico or even wider, the moment Vegas becomes an option again, people are going to hop on that flight, go to Vegas, start gambling, markets come up. It's one of the few cities in North America that relies solely on money coming in. And if you rely on money coming in, it means money can be made anywhere in the world. And then you become more attractive. You see how Vegas is always a good situation? We're going to be there in less than 2 weeks to take a look at this market. Right now may not be the best time, but you know what? We'll keep going back every month and a half to check it out. This is of personal interest and within my group. All right, so that basically wraps that up. If you found this interesting, please hit like, subscribe, comment. We will get back to absolutely everything. Let us know what segment of this recession crash you would like to hear about next. Do you want to hear about automotive? Do you want to hear more about property? Are there cities you want us to look into to help you with your knowledge? Let us know. But for now, I'm Chris, and we're out.